Preparing for a banking at Gulf Bank Kuwait interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me what you know about Gulf Bank Kuwait, and why you want to work here. I see Gulf Bank as one of Kuwait's leading conventional banks, with a strong retail franchise, corporate banking presence, and continued investment in digital channels. What attracts me is the mix of customer focus, risk discipline, and transformation. I want a role where I can build banking fundamentals, support clients professionally, and contribute to measurable growth, while working within a regulated institution that values trust and long-term relationships in the Kuwaiti market. While answering, focus on Gulf Bank's position in Kuwait, its conventional banking model, retail and corporate presence, digital transformation, customer focus, and why your skills fit a regulated banking environment. Question 2. How does a commercial bank like Gulf Bank make money? A commercial bank mainly earns through the spread between what it pays on deposits and what it earns on loans and investments. For example, if deposits cost 2%, and lending yields 5%, the difference supports net interest income. Gulf Bank would also generate fees from cards, transfers, trade finance, account services, and treasury products. The key is not just growth, but profitable growth, with strong credit quality, liquidity, capital, and compliance controls. Make sure to cover net interest income, fee income, treasury activities, credit risk pricing, funding cost, and why profitability must be balanced with liquidity, capital adequacy, and regulatory requirements. Question 3. If a customer applies for a personal loan, what factors would you review before approval? I would start with affordability, not just eligibility. I would verify the customer's salary, employer, length of employment, existing obligations, credit bureau record, and debt burden ratio under Central Bank of Kuwait guidelines. I would also check the purpose of the loan, documentation completeness, and any past delays or restructuring history. A good approval decision should protect both the customer and the bank by ensuring repayment capacity is realistic. In your answer, talk about income stability, debt burden ratio, credit history, employer profile, loan purpose, documentation, Central Bank of Kuwait rules, affordability, and responsible lending standards. Question 4. What is a non-performing loan, and why does it matter to a bank? A non-performing loan is a loan where the borrower is no longer meeting repayment obligations, usually after a defined overdue period or clear evidence of financial difficulty. It matters because the bank may stop recognizing normal income, increase provisions, and allocate more capital against the exposure. High NPLs weaken profitability and market confidence. That is why early warning signals, restructuring discipline, collateral monitoring, and strong collection processes are critical. Be sure to mention overdue status, impaired credit quality, effect on profitability, provisioning, capital, collection effort, risk indicators, and the importance of early warning signals before default occurs. Question 5. Explain International Financial Reporting Standards 9 expected credit loss provisioning in simple terms. International Financial Reporting Standards 9 requires banks to estimate credit losses before they actually happen. Loans are grouped into stages. Stage 1 for performing assets, Stage 2 when credit risk has increased significantly, and Stage 3 when the loan is impaired. The provision depends on probability of default, loss given default, and exposure at default. It is forward-looking, so economic factors like oil prices, employment, interest rates, and property values can affect expected losses. While answering, focus on forward-looking loss estimation, Stage 1, Stage 2, Stage 3, probability of default, loss given default, exposure at default, and why macroeconomic assumptions matter. Question 6. Why are CASA deposits important for a bank? CASA means current account and savings account balances, and they are valuable because they usually provide low-cost, stable funding. If Gulf Bank can build strong salary account relationships and everyday banking usage, It reduces reliance on more expensive fixed deposits or wholesale funding. That supports net interest margin and liquidity. CASA also creates cross-sell opportunities because customers who use the bank daily are more likely to take cards, loans, remittances, and digital services. Make sure to cover current accounts, savings accounts, low-cost funding, net interest margin, customer stickiness, liquidity benefits, and why banks compete hard for salary accounts and primary relationships. Question 7. How would you handle an angry customer at a Gulf Bank branch or contact center? I would first let the customer explain the issue without interruption and show that I understand the frustration. Then I would verify the account details securely, review the transaction or service history, and explain what can be done within policy. If the matter needs approval or investigation, I would escalate it with clear notes and timelines. The goal is to stay calm, protect customer confidentiality, and turn a negative experience into a controlled resolution. In your answer, talk about listening calmly, acknowledging the issue, verifying facts, protecting confidentiality, explaining policy clearly, escalating when needed, and closing the loop with the customer. Question 8. What KYC and AML red flags should a banker watch for? KYC is about knowing who the customer is, what they do, and whether their transactions make sense. Red flags include inconsistent source of funds, frequent cash deposits just below reporting thresholds, transfers to high-risk jurisdictions, reluctance to provide documents, unusual third-party activity, or sanctions and PEP concerns. I would not make assumptions, but I would document the facts and escalate to compliance through the proper internal process. Be sure to mention customer identification, source of funds, unusual transaction patterns, structuring, sanctions screening, politically exposed persons, high-risk jurisdictions, documentation gaps, and escalation to compliance. Question 9. How would you assess the creditworthiness of a corporate client? I would begin by understanding the client's business model, industry position, customers, suppliers, and management quality. Then I would analyze revenue trends, margins, leverage, liquidity, cash conversion cycle, and debt service coverage. Banking conduct also matters: account turnover, check returns, utilization patterns, and repayment history. Collateral is useful, but the primary repayment source should be operating cash flow. A strong credit proposal connects risk, facility structure, pricing, and monitoring. While answering, focus on business model, industry risk, management quality, financial statements, cash flow coverage, leverage, working capital, collateral, banking conduct, and repayment source, rather than collateral alone. Question 10. How do interest rate changes affect a bank's profitability and balance sheet? Interest rate changes affect both income and valuation. If loan yields reprice faster than deposit costs, net interest margin may improve. If funding costs rise faster, margins compress. Higher rates can also reduce loan demand and increase repayment stress for some borrowers. On the balance sheet, bond prices may fall when rates rise. That is why banks use asset liability management to monitor repricing gaps, liquidity, duration, and earnings sensitivity. Make sure to cover asset liability repricing, net interest margin, deposit costs, loan demand, bond valuation, customer behavior, and why ALM teams monitor gaps and duration risk. Question 11. What operational risks can occur in a bank branch, and how would you reduce them? Operational risk in a branch can come from cash shortages, wrong account postings, missing documentation, unauthorized approvals, fraud, or system misuse. I would reduce it through strict maker-checker controls, dual custody for cash and sensitive items, daily reconciliations, proper customer verification, and clean documentation. I would also follow access controls and escalation procedures. In banking, small process gaps can become financial, regulatory, and reputational issues very quickly. In your answer, talk about cash errors, unauthorized transactions, document mistakes, system access, fraud, dual control, maker-checker review, reconciliations, segregation of duties, and audit readiness. Question 12. How would you sell a credit card, loan, or account product ethically? Ethical selling starts with understanding the customer's need, not pushing a product. If a customer wants a credit card, I would explain the benefits, fees, interest charges, payment due dates, and consequences of late payment. For loans, I would confirm affordability and avoid encouraging unnecessary borrowing. A sale is only successful if the customer understands the product and it remains suitable. That protects the customer, the bank, and my credibility. Be sure to mention needs-based selling, suitability, transparent pricing, fees, risks, eligibility, no misrepresentation, customer affordability, documentation, and long-term relationship value over short-term sales targets. Question 13. What do Basel III capital and liquidity requirements mean for a bank? Basel III is designed to make banks more resilient. Capital rules require banks to hold enough high-quality capital against risk-weighted assets, so unexpected losses do not threaten solvency. Liquidity rules, such as the liquidity coverage ratio and net stable funding ratio, ensure banks can meet cash outflows under stress. For a bank like Gulf Bank, these rules influence lending growth, treasury strategy, balance sheet composition, and risk appetite. While answering, focus on capital adequacy, risk-weighted assets, common equity, leverage, liquidity coverage ratio, net stable funding ratio, stress resilience, and regulatory confidence. Question 14. How is conventional banking different from Islamic banking in Kuwait? Conventional banking generally uses interest-based deposits and loans, while Islamic banking structures products to comply with Sharia principles, often using contracts such as murabaha, ijara, or mudaraba. In Kuwait, customers may choose based on religious preference, pricing, service, and product features. Gulf Bank operates as a conventional bank, so it competes by offering strong service, digital convenience, credit discipline, and relationship banking, while remaining compliant with Central Bank of Kuwait regulations. Make sure to cover interest-based lending, Sharia-compliant contracts, profit-sharing or asset-backed structures, product documentation, customer choice, regulatory oversight, and Gulf Bank's position as a conventional bank. Question 15. If you found a cash mismatch or transaction error at day end, what would you do? I would treat it as a control issue and follow procedure immediately. First, I would recount cash, review transaction slips, compare system entries, and check whether any posting or denomination error occurred. I would inform the supervisor, rather than trying to fix it informally. If the mismatch remains, I would document the details, support the investigation, and follow the bank's approval process. Accuracy and transparency matter more than hiding a small mistake. In your answer, talk about stopping assumptions, recounting cash, reviewing vouchers, checking system entries, informing the supervisor, documenting the issue, following branch procedures, and avoiding unauthorized corrections. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.